live. I'm with Matthew Queen. Hello, happy Friday.
Hi, happy Friday to you.
Yeah, we're going to be talking about captives. And Matthew, why don't you describe what you do for your day job?
I am the U.S. vendor claims manager with Hiscox. I was, previous to that, general counsel with Venture Captive Management as the, which was functioning almost like a blend between an MGA and a captive manager. So in that role, I became somewhat of a subject matter expert in captives. I wrote a book called Modern Captive Insurance with my co-author, Light Townsend. And that role basically became almost like training for insurance carriers 101. I think what's interesting about captives, they kind of come in two broad varieties. You've got let's just call them legitimate captives, which function like small insurance companies, and that's what we did. And then you also have kind of the tax-efficient captives, which, although technically insurance companies really don't function anything like the sort and have been pilloried by the IRS. So it's a pretty fascinating area. I would call it kind of the zenith of risk management. I think that whenever you're looking in the captive area, you have probably either run out of options in traditional insurance, or you decided to take your risk management to the next level because traditional markets are failing you for some reason.
Yep. And that's exactly why I reached out to you on this, because I consider you a subject matter expert on it. And given the environment that we're in, a lot of conversations that both you and I have participated with on Twitter, and probably you have as well, solely in other channels, as well as the entire concept of business interruption when it comes to pandemics. Generally not a covered peril. I'll leave the conversation to the drama around what the states are doing and whether it's civil ordinance or not. But it just gets down to I had this conversation with someone who is very close to the San Jose Sharks, and he not being necessarily an insurance professional, commented on, there's got to be a way that this never happens to us again. And the fallout to something like this is, this doesn't just affect the San Jose Sharks. This affects all of the vendors to those hockey games, the stadium owner, the restaurants and other things in other areas, the television and radio stations. And as I started to think of that, I said, I wonder if there's a captive solution to this. And I don't know enough, so let me go to the source. So as we kind of peel back the onions on this, Matthew, maybe start off quickly and just talk about what is a captive. You talked about taking it to the next level, but if you could succinctly, Twitter-wise, 260 character this thing, how would you classify or define a captive?
A captive insurance company is a tax advantage savings account. It's no more complicated than that. So, if I put my money in the Bank of America account over here and I put it in my captive insurance company over here, there's no difference except when I put it into a captive insurance company, Section 162 of the Internal Revenue Code provides for a deduction for businesses to take for insurance. So if we can take the money that we're otherwise saving for a rainy day and suddenly create a tax deduction for doing so, you're now winning in two directions. So all of the rigmarole in terms of, it's a relatively complex, this is my book, and all of this is just a way to get a tax deduction. That's all it is. In fact, a way to think about captives is just they're financing a self-insured retention, or they're financing an extremely large deductible. So that's probably the safest way to use a captive. You are looking at some problem, in this case, pandemics. And let's just dive right into it. Like, how would a captive work in the situation like this?
Please go.
So we're dealing with something that is practically an uninsurable interest. So we have captives for earthquakes. We have captives for flood. So pandemic would kind of fall in that general area. What you would want to do is you would probably want to bring in an actuary to help you kind of scope out what is the cost of the risk. So here, obviously, business interruption is what we're talking about. So business interruption is going to be very difficult to finance. Business interruption insurance can be very difficult to find on the private markets or even in the E&S space. So what you would do is you basically just calculate out, okay, what's the cost of premium for, financing our company for 6 months, 12 months, 18 months, and then you just put it into a captive. So specifically, how do you do that? Well, you're probably going to need a minimum of $250,000 of capital to put into an insurance company. All right, so that's
repeat that.
Yeah. So this is just Captive 101. How do you, about $250,000 at a minimum. Okay. So there are domiciles I'll let you get away with less, but let's just talk about like a middle market or even a small business. If some small businesses want to come together, there is an opportunity here. So what you would need is what? To get your tax deduction, you need to have an insurance company, which comes with 2 licenses. Number 1, the corporate license. Number 2, the insurance company license. So step 1 is get your corporate license. You can do that in literally any state, and not exactly every state. Some states don't have captive laws like California, but 35 or so states are available, and a handful of places across the world. I've got a lot of experience in the Caribbean. They are fantastic, and their minimum statutory capital down there is about $100,000. You don't want to go with the minimum because you have to maintain something called your surplus ratio. At the end of the day, you need to make sure that your premium surplus ratio is about 5 to 1. You can start off at like a 10 to 1 where you essentially just grow your surplus over time, but then you're really rolling the dice hoping you don't actually have a claim because all of a sudden you have an insolvent insurance company. And that's one of the very, very few things that can get a regulator angry at you in the captive space. So step 1 is set up the corporation, which you can do just like any other corporation. I won't go through that. The insurance license, generally speaking, just requires you to have a bank account with the minimum statutory capital, which would be, again, $100,000 in your smaller domiciles. And in America, it can be as high as $500,000. So then you fill in an application, you do a little bit of paperwork, so long as you're upstanding member of society, you get in every single time. Problems, and this is unfair, if you've ever had a bankruptcy, it's going to be tough. I had a guy who got screwed in 2008, and I had to basically say, I'm sorry, we have to find someone else to step in as a director and officer of that captive. It wasn't fair. I mean, it's just the way it is. So once you get your license up and running, we now have to protect that tax deduction. Because you can have a captive, let's just say we establish one in Bermuda, but the IRS doesn't have to recognize those premiums. I mean, that really is the driving factor here. It doesn't matter if you're General Motors or some small business. If you go through the time and expense of an insurance company, you need to get that tax deduction. So then what you do is you have to make sure that you have risk transfer, risk distribution. We can go into those rules later, but the quick and dirty way of getting there is make sure that you have an actuary calculate out the premium correctly. So that would require a reserve study and a rate study to make sure that you've basically got a real company. The actuaries are going to be worth their weight in gold. There are some chop shop actuaries who put together basically phony baloney captives that write phantom risks. We're talking about $1 million policy limits for a laptop. I mean, just stupid things. And the IRS correctly looked at that and said, okay, that's correct, because there's another tax advantage to this. If your captive writes less than $2.3 million in gross written premium, you don't have to declare any underwriting profit. The only profits in the captive would be from the reserves. So your bonds, the investments, that sort of thing. And if you get really creative, you can have your reserves invested in your own real estate and go nuts with the tax advantages. So the IRS caught on to that real quick. And they said, okay, given the tax advantages here, we really do need to see some actual risk in there. So does pandemic qualify as actual risk? Well, yes. I don't think there's any debate on that. So then how would we actually get this done? Like, is this worthwhile investment? I would say if your business cannot stand an interruption like this and you want to put some money aside, a captive would be a really smart way of getting it done. Now, the startup costs for a captive are no joke. So I've already said that you got to have a hundy just to play the game, and probably more like $250,000 if you're in the U.S. So what do? Well, this is where groups can come together. So maybe we find 10 or 20 small businesses or medium-sized businesses, and we can just basically all go all in. And if there is a claim, we're all basically going to be pulling from the same pool. So that'll get you to your risk distribution. That'll help out with diversifying so that, if we do shut down one area of the country, maybe we've got enough in reserve so that we don't bankrupt the captive. I mean, there's a lot of advantages to working together as a group. I would say that is easier said than done. We've tried to put together group captives for things that are really hard to insure, like PEOs for workers' comp. And just getting everyone to sing from the same hymnal is heavy lifting. But it happens. It happens all the time. You got risk retention groups, it's like kind of a captive. You got mutual companies, not a captive, but generally in the same kind of vein, where people are willing to work together. So I think there are some opportunities in the market out there for enterprising people who want to take a more aggressive stance on pandemic. So then the question becomes, well, then how do I not lose my shirt? So if we have, let's say the captive is going to have policy limit of $1 million, then how do you actually implement that in such a way that we don't just bankrupt ourselves because of moral hazard? Everyone's going to be, making claims on it all the time. So what you do in a group situation is, first and foremost, you probably want to consider stop loss. So maybe the captive really, like I said earlier, is functioning as like a large deductible. So you'd have the captive pay out the first X, and then insurance, private insurance or a traditional carrier would pay up above some attachment point. And you do that for both spec and ag, so frequency as well as shock risk. That's one way of doing it. Another way of trying to protect the capital is to do some swing rated plans. So that's some creative underwriting where those who are creating all the problems end up paying a little bit more premium next year. You can do a catch up in the same year with proper underwriting. So the underwriter really needs to be kind of on their game to be able to enforce that. But there's definitely ways to get there. What I would be skeptical of is just joining up to any old risk pool. Risk pools are, if you get in the wrong one, you could end up paying a lot more in the long run than if you just self-insured.
Yeah. So there's a couple aspects there I kind of want to dig into, which is you talked about limitations, and you mentioned something about limitation of premium. Is that a limitation of what can be deducted, or is that actually a limitation on the size of the program, of the captive?
Okay, so the premium limitation I was getting at earlier is for the 831B election. So my stance on that is it is an incredible tax advantage to not have to pay any taxes on your underwriting profits. I mean, duh. But you don't want the tax tail to wag the dog. So I wouldn't even consider the 831B election at first. I think that when you're talking about business interruption for pandemic insurance, most of your players are probably not going to have greater than $2.3 million in gross written premium. It's not reasonable. Most of your mid-market companies, I don't know what the premium would look like, but what do you think is reasonable? $350,000, $400,000? I mean, that's probably a pretty big chunk right there for a lot of people to swallow. So I think the 831B election will probably be in effect for most of these people, but it's not a limit per se. It's just a tax thing. So you can make the election, you can unwind the election. It's just accounting.
Yeah. So, but what about like a Fortune 1000 or 2000 company that has a significant exposure? Let's go back to the San Jose Sharks. They canceled their season, so we're talking potentially tens of millions of dollars of lost revenue for that. So what would be the limitation for larger than the mid-sized companies?
There is none. There is none. I mean, fundamentally speaking, captives are about capitalism. So if I come to you and I say that, do you want to make an insurance company? I hope the answer is yes. And we have a number of options. We have mutuals, we have reciprocals, we've got all sorts of exotic types of insurance companies, and a captive is just one of them. So General Motors, for example, I know for a fact, has multiple captives over in Bermuda. Because, General Motors has Cadillac and Chevrolet and blah, blah, blah. Yeah. And within each of those units, they have a whole bunch of companies you've never even heard of, like their R&D division may actually be its own C corporation owned by someone else, blah, 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 blah. They all have a bunch of self-insurance. Because, they just have unique risks. So they literally will poach talent from large carriers and then bring them in-house to basically just run a bespoke insurance company and get some additional tax advantages for taking essentially the working layer of the risk within their captive, and then they lay off the rest to commercial markets.
Yeah, I see. So how about you mentioned risk pooling with groups. I bet traditionally that's done with like kind and quality. But what about the example that I described where, again, San Jose Sharks, you have the stadium owner, you have the vendors, you have the local community, you have the television and radio stations. Would a disparate group also potentially qualify to form a captive for an event cancellation?
Yeah, as a matter of fact, there's called homogeneous and heterogeneous captives, and there's absolutely nothing wrong with having a bunch of people in there who are not ostensibly in the same business, but if they're in the same general area, I think that makes a lot of sense. Of course, my concern there would be, it's almost academic, but like risk aggregation. So you don't want to insure just a whole bunch of houses in Florida. You want to diversify a little bit because God forbid you have a hurricane. So the problem is there, it is a bit of an academic concern. You don't want to have all of your eggs in one basket, but we're talking about pandemics where the basket is planet Earth. So theoretically, distributing the risk can be pretty hard to do.
Yeah. What about, the situations where, I'm thinking of why it almost seems like this is a mutual. So why not just mutualize? Or what is the distinction between the two? Because, a mutual insurer is, like a factory mutual would be factories that kind of get together so they can get economies of scale and learn from within themselves the risk management that's required to manage against fires, for instance. Yeah. This seems like almost the exact same thing. What is that thin dividing line that kind of separates those two?
So when captives were created by a guy named Fred Reese back in the late 50s, they were captive. They were essentially a subsidiary company of a company. So it was captive to a larger company. So the initial thought was that a commercial insurer, are you still there?
Yes. Yeah.
Very good. Okay. So the commercial insurance market's failure would require us to self-insure for some reason. And the IRS was dead set against this. They looked at it as kind of the same economic family. And like I said earlier, a savings account over here, now it's magically a tax deduction if we put in this other bank account. So there was literally decades of fighting over whether or not a captive could exist. Eventually, in the Humana case in the late 80s, the IRS was just blown out of the water. There was just absolutely no question about it. Captive insurance is a legitimate thing. And that's why I'm going back to the concept of capitalism. Who the heck are you to tell me that I cannot create my own insurance company just because I can make my own bank. Why can't I make my own insurance company? And eventually, although that wasn't necessarily stated in the opinion, that element of entrepreneurship is definitely pushing the entire engine of captive insurance. So then moving forward to how does it differ from a mutual, the answer is as the concept of a captive has expanded over the years, because now I could theoretically create a captive apropos of nothing. Some domiciles will allow an outsider like you and I can raise funds and create an insurance company under the captive statute. So where does that differ from a mutual? The answer is not as much as it used to. It is separate and distinct. Now mutuals are different. Okay, at the end of the day, when you purchase an insurance policy from a mutual, you are a policyholder of the mutual, but you're not really calling the shots. Practically speaking, and we're kind of exiting the courtroom and getting into more like street law. Practically speaking, if you're in a captive, you can call the shots because you're going to own a significant chunk of it. Or if you're in a group captive, you're owning your own little fiefdom of the captive. So you can appoint counsel, you can appoint the loss adjusters, you can do all sorts of crazy things in underwriting. So like, here's a good one we did. We were dissatisfied with the way that risks were working between these various healthcare facilities. So we started using the captive. We would actually charge more premium within a quarter. We would, like on a quarter by quarter basis, we would basically punish these facilities that had way too many accidents. And wouldn't you know it, that an increase in premium to those facilities went directly to the administrator of that facility's bonus. Consequently, accidents vanished overnight. that's the kind of flexibility you have with a captive that you just won't have with with a mutual.
Yeah. Like the mob, is there an ability, if the captive is successful, to go legitimate and become a mutual or a standard carrier?
Yeah, look at Allstate. It was Sears and Roebuck's captive.
Okay. How in your book, how much do you go into like the historical aspects of this?
Quite a bit, as a matter of fact.
Okay.
I mean, I really look at when you look at the history of captives, you see not only the history of kind of like American entrepreneurial spirit, but you also see the zenith of risk financing. I mean, it is probably one of the most interesting places where you can really manipulate the concept of risk. How does it flow through an organization? Let's talk about what's insured, what's not insured. I feel like in every other aspect of the industry, we just get so caught up in that's the farm. Is it covered? Is it not covered? A side, B side, all that stuff. I mean, that's all important. You have to know that. But at the end of the day, are you just pushing paper? And with a captive, you're not. I mean, I laugh about coverage and captives all the time. And I openly say I don't know anything about captives or coverage, because in a captive, who cares about coverage? I mean, it's your own insurance company. We'll paper it up to make sure that, it looks good, but we're really plugging risk. So what's the biggest problems that keep you up at night? So, I mean, right now, obviously, pandemic's on the top of everyone's mind, but, another thing we've been seeing is, hail insurance, and anyway, basically from Texas all the way up to Colorado, is virtually uninsurable. So if the deductible that the carriers are asking for is greater than the replacement cost of your roof, you ought to put that self-insured retention into a captive, so that if you do have to pay the deductible, all of a sudden you've already pre-financed it, got those tax deductions, and then your captive is one that's actually paying the insurance company that enormous deductible.
Or better yet, in that example you just described, it puts the incentive on now the owner of the captive to enhance risk management.
Yes.
Set up a risk management so you never pay a claim and you have full control, and now you're able to really leverage against the insurance companies and keep more of the premium that you would have been spending.
At the end of the day, the goal of a captive is to expand north on the limits. So let's say we're keeping at first on a 1 mil, 3 mil policy, we'll keep the first $250,000. And then with good risk management, we don't have too many claims. So then you can have enough reserves to capture $500,000, $750,000, and $1 million. And as you grow, that's exactly right. You're kind of pushing the traditional carriers away as you're finding more efficiencies through your own captive. It is very difficult for captives and carriers to play well together. That is something that I think probably works very well for the consumers, because at the end of the day, where the market fails, the captives are really supposed to be in there kind of picking up the pieces.
Yeah, that's interesting. So this is a great message, right? And I think a lot of folks that are listening are going to be like, why didn't I know about this? I want to learn more. So I'll put the show notes, I'll put access to your book and a few links that I found on this. But there is a bad side to this. Like if you Google captives and you start reading about it, you'll see that the IRS is coming down hard, and there are people out there that may not necessarily have your best interest at heart. Can you talk about that other side that has sort of given this a little bit of a bad name over the past few years, so we can kind of clean that up and potentially get people focused on who's doing the good work here and how to get that done?
Yeah. The tax deduction I expressed earlier was wild. I mean, you talk about, I mean, that sucking sound dollars of taxable wealth, both on income tax side and on the estate planning side, that got transferred from, let's just say, early 2000 to about 2015. So that was a long time. And there were some people in the industry who made a lot of money doing that. The best time to get into a tax dodge is before the IRS finds out about it. And the IRS is very slow. When they finally figured it all out in circa 2012, 2014, they didn't win a case in it until 2016, the Abrahami case. Now, why am I telling that to you? I'm telling that to you because the riffraff has pretty much been kicked out of the industry.
Okay.
But man, it was wild. And the way the IRS figured it all out, it was subsequent to a case called Rent-A-Center and Securus. There was these two different cases, Rent-A-Center and Securus. Long story short, the IRS had a very specific way of looking at this concept called risk distribution. Everyone else disagreed. They got their butts handed to them, and then they're looking to lose. There was a tax conference in Washington, D.C. in 2014 where a captive manager got in front of the whole audience and basically just started trumpeting what a great deal the 831B election was with the IRS in the room. And it wasn't a mystery theory in the room. It was a tax conference. The service shows up all the time. And this guy just outlines the world's greatest tax dodge in front of that service that had just gotten its butt kicked in two separate federal cases. They went back and immediately sent out, and this is not a joke, private, like plainclothes investigators to go down to the Caribbean, start investigating this stuff, figure out who's the big fish, who's the small fish, and then they were very smart. They bided their time until they found the world's stupidest captive manager up in Manhattan. She, as far as I can tell, has no business in the insurance industry. She was just an LLM, which is, it's like a master's for a lawyer. She's super good at tax, but she was just running this disgusting risk pool. It was total fraud, and the IRS just made an absolute smart play with that. They used her as the poster child for bad captive insurance. They beat the tar out of them in court, and then they went after a whole bunch of other big fish, these risk pools that were essentially just tax dodges. So from 2016 through probably, I mean, I'd say it's pretty much over now, but for about 4 years there, these risk pools just got audited. And I mean, we're talking probably another decade of class action litigation from these very wealthy, very angry, primarily doctors and those kinds of people who, you know, they're having to pay millions of dollars to the IRS.
Wow. That is a drama, I think, that needs a screenplay.
Yeah. Well, I mean,
you're an author.
It's like what you learned in finance. You ever figure out how to beat the market? Don't tell people. So, I mean, I don't know why they were bragging about tax dodge that brazenly.
This was great. Thank you, Matthew Queen. I will put, can you share your book again?
No, I had to plug in my phone on the other end of the room.
Oh, geez. You're so mobile. What's the name of it again?
Modern Captive Insurance.
I will put the links up for that, a few other links as well. Thank you for the quick education on captives. Appreciate it.
Cool, man.
Okay.
Anytime. Talk to you soon.